With that big warning in the bond market, as stocks hit record highs once again today, the yield in the 10-year fell to its lowest level since March 3rd. And the chartmaster says rates are going to collapse even further from here. Cornerstone Macro's Carter Worth is here to break it down. Kick it off for us, Carter.
You bet. I mean, so hard to know, of course, but it's such an important subject, and it's obviously one of the biggest single securities there is, the 10-year Treasury bond, and where yields are, where rates are, determine valuation for equities and mortgages, and so much of this it really matters. And my hunch is that this weakness is not over, and that there is more downside to go. Basically, we're looking as low as 125. Now, you know, we'll look at a few charts, but is that much? Meaning we're at 145 now? We'll see. So, 4 charts. The first is the channel that yields have been ascending since last summer. And so when this was introduced, at least I'm sure other people have their own channels, but in our work, we've relied on it heavily. And in fact, you see those arrows there. I've tried to make some tactical calls in TLT and the Treasury market. Now, the issue is, starting in late May, when we approached the bottom of the channel once again, we didn't really approach the bottom of the channel. Rates went sideways. They stalled. And the channel, by simply rising, they met. They bumped into one another. That's an arbitrary moment in time. You don't get a bounce off the lower end of a channel if you haven't come down to it. If you just meandered sideways and it's come up to you, nothing happens. And indeed, we've broken below. And you can see that on the chart. Now, the second chart, and this is why this week we retired the channel, if you will, with honors, so to speak. The second chart shows why the channel is no longer relevant. And that line drawn there, that is June 30. For rates to be in the channel, rates would have to go back to 182 in the next 13 trading sessions. That's not likely to happen. Take a look at the next chart. That second line drawn, that's July 30. Rates would have to be at 2.1 in order to get back into the channel. By July 30, I would say the odds of that are 0. So the question is, why down? This is so unexpected for consensus, this move lower. I think it's got more to go. And the final chart, and you could say this is arbitrary, but it's really not. The 125 level, you'll see where I've drawn the line. All of the moving yields was done in about 30 days. It was basically the last days of January to February. We went from 1% to 177. And all we've been doing since, and it's already mid-June, is slumping. And I think the slump continues.
All right, Carter, thank you. Carter Braxton Worth, we'll see you in a few minutes on Options Action. All right, in a world in which yields hit 125, Dan, what does that look like? I mean, in terms of the economy, does that mean that we're in for a slowdown of some sort?
Well, it's really funny. If you think back to after the financial crisis, do you remember like in 2010, 11, 12, the obsession was a double dip recession, right? And it gave the Fed a lot of cover to kind of keep ZIRP and keep the quantitative easing the way it was. And I think it's really important to kind of think back to what that playbook it was. I know a lot has changed, but think about the taper tantrum in 2013. We saw the 10-year U.S. Treasury yield go to 3% or so. But once they started tapering, the yield went all the way down to 1.5%. And they didn't start coming off that zero interest rate bound until 2015, late 2015. So to Carter's point, I think Tim mentioned this last night, if the tapering is coming and if the data is getting maybe a little weaker, we just had those 2 hot CPI prints, but we've had 2 disappointing jobs prints. If the data is weaker, maybe they start to taper a little bit. They're going to sell off the corporate bonds. Maybe they buy less MBS is one thought, but maybe rates can come into that 200-day moving average in the 10-year U.S. Treasury yield down near 1.15. So
that's sort of the opposite. I mean, just to fill in people who didn't watch, I mean, I know some of you may not have caught fast money yesterday, which is shocking, but that happens. Tim Seymour was making the point that perhaps what we're seeing in terms of the slump in yields is that the bond market is anticipating a couple of steps ahead of the stock market, that the Fed will in fact begin to taper because inflation is in fact transitory. We get the economy reopened. They move to taper. Bonds go up, yields go down.
But what happens if the simple answer is we entered this in a deflationary environment? So Chairman Powell said that there was no inflation. What happens if there is no inflation? Is that bad for the markets? Is it good for the markets? It was good for the markets back then. So what happens now if what you just said is that indicative of a slump in the economy? I think it's indicative that the market's going to run higher because the Fed is going to be accommodative. We're going to have squishy financial policy and no inflation. So doesn't that make you think that assets or certain risk assets can continue to move higher? The problem is, can value move higher? So we've seen growth into value. What does value do?
Well, in a world in which yields are 1.25, let's say, Victoria, I mean, you would think that this gives a massive reprieve for the tech trade, in particular the high valuation stocks across the tech trade or across industries for that matter.
You're right. So you talk about the growth in the value trade. Well, that should be a little boost in the arm of the growth trade. Those are the stocks that got hit so hard when we saw yields move back up in March. But the yields were moving so much higher because people didn't have faith in what the Fed was saying. They didn't believe that inflation was going to be transitory. And I think there's kind of been a consolidation of thought there. I think the market now believes probably the majority of inflation is transitory, not all of it, but the majority. You're going to get a smaller infrastructure package. So it makes sense that yields have come down a little bit. What I'm hoping we see, not just because I manage taxable fixed income portfolios, but I hope we see rates turn around and go a little bit higher as the base effects roll off and we do see kind of a handoff of inflation from transitory to wages to rents, things that are a little stickier. Europe starts to open up and pulls our yields higher that way as well. And so I think we can see rates, yes, they might come down in the short term, but I think we'll see a steeper yield curve with the Fed maintaining where they are and inflation expectations starting to rise again as we get towards the end of the year.
James, what's your take on a world in which yields go to 1.25?
We've been looking at correlations for equities for some time with rates being a risk factor. And we've seen a lot of buying interest in tech correlated with this drop in treasuries here, not just this past week, but really for the past month. And it also coincides with new potential 52-week highs. We're seeing that with the S&P. We've seen it with the Russell close. And now NASDAQ is getting back up there. We've seen most pressure in the market around tech. And I know we're going to talk about some big tech names later in the show. But we're knocking on another 52-week high, and I think that this move in treasuries is somewhat of an indicator of sentiment in terms of the equities going higher with this rate move, with rates having been a discussion about risk before. So I think it's not necessarily reactionary, but I think it's correlated, and I think tech is going to be the benefactor.
Yeah, so Mel, you just mentioned, though, what are some of the trades, right, off of a lower interest rate environment, which a lot of people, I think that the rest of the panel has just said, are not really positioned for. And you think in the stock market, some of the things that we're seeing. So you mentioned a big cap tech has caught this bid. What about CAT? What about Deere? Some of these cyclical names, industrials that you saw a major rotation as that people were coming out of tech into those things are rolling over right now. We were talking last night about home builders, and think about some of the input costs that we've seen in there. We've seen lumber come in 30% from those recent highs. That seemed like a frenzy. We're talking about, well, those are the sorts of supply-demand imbalances that we've seen, at least over my career, that have really fixed themselves. They tend to be pretty transitory. I don't think that there's anything going to be structurally changed about how Americans live, you know what I mean? That sort of thing. So, at the end of the day, I think if you look under the hood, we're going to get really comfortable with money going back into big cap tech. We know the moats, we know the monopolies, we know the managements, that sort of thing. And then you might see some of these things that kind of overshot to the upside, that did overshoot to the downside during the throes of the pandemic sell-off. They may start to come in and kind of get to a level where valuations make a little bit more sense and where they're not over-anticipating a overly strong economy.
What you're talking about is the infrastructure plan that Victoria spoke about. Yeah. If it's only 6 or 8% real bridges, tunnels, roads, how can a CAT, a Deere, or URI really run?
You think that the entire run for those stocks, though, was predicated on an infrastructure bill passing?
No, I think it was rates going higher, reopening, and busting out. So that's where I have been perplexed, because when you look at rates rolling over, CAT should be sold. When you look at the economy reopening, CAT should be bought, regardless of where rates are. So that's where I am. I'm somewhere in the middle right now.
Where are you on chemicals and materials?
I'm still long them because they've all doubled. All these chemical names have doubled, so I'm still long them, but they are definitely flattening out. And to Dan's point, They are not at their highs. They're probably 15, 20% off their highs, but they're still 40, 50, 80% higher than when I bought them. So I'm sort of waiting for this reopening to happen to see how gangbusters the economy goes, because that's what I think is going to happen.
If the bond market's already 2 steps, I mean, in theory, if the bond market is in fact 2 steps ahead of the stock market, Victoria, then that would tell me that it is time to rotate out of this reopening trade. It's time to get out of materials. It's time to get out of cyclicals. What's your take on where to be right now if the bond market is right?
Well, Melissa, I know people don't like to hear the word barbell when it comes to their portfolio, but I think this is the exact environment when a barbell portfolio makes perfect sense. And it's exactly because of what Steve was talking about. Some of the moves that we've seen really don't coincide with what you would expect with a reopening trade or with rates moving lower. So do you have exposure to some of those growth names, those even secular growth names, some of the tech names? Absolutely. I think you need them in your portfolio. Does that mean you completely come out of your cyclical names? Not at all. I mean, I think you need a Deere, you need a Honeywell. We own those in our portfolio. You need a JP Morgan in your portfolio. You need to have some of those cyclical components as well. This is where things are going to get really tough, whereas maybe the last year it was easier to jump in on a sector or jump in on a theme and do well regardless. Now the fundamentals are really going to come into play. Stock picking is going to be key. You really need to pick your names and look at the balance sheets, but I think the barbell approach works.
James, I haven't known you for a long time, but I don't feel like you're a barbell kind of guy.
Whoa, is that an insult?
No. I mean, using a barbell as opposed to investing style, 2 different things. But how would you characterize your portfolios now at this juncture in the market?
I agree with Victoria. You have to be very disciplined about analyzing the merits of an individual security, both in the context of its individual fundamental performance and in the context of the environment it plays in. I think we're late cycle equities here. We keep knocking on 52-week highs. There have been record after record set, and we're in an unusual period of monetary policy. And so I think examining the metrics within a specific security, within the specific space, and then obviously suitability. We're all growth focused here at Hercules. And so we are definitely analyzing individual securities because I think there's going to be a flight to quality as markets will need to get choppy coming into the summer and coming into the fall. As we see how the reopening actually performs.
Yeah, James just mentioned the word choppy, and I think back to the post-financial crisis. I just mentioned the obsession with the double-dip recession fears, but also global growth. This was a rolling credit crisis, if you recall. We came out of it first, and then it was in Europe, and then it was Asia. And if you think back to 15 and 16, when we were trying to normalize our interest rate policy, we saw tons of volatility across over every major asset class, specifically about China growth and that sort of thing. So I think that the idea that we're just going to be reopen and it's off to the races for the next decade doesn't make a whole heck of a lot of sense, especially when you consider in 2021, we've had about 3 peak to trough declines, about 4.5%. Those are pretty run of the mill here. So if there's any reason to sell off, I think the complacency is very high. You saw the VIX trade 15.5 today. It seems like we could be ready for some sort of growth sort of scare in the not so distant future.
Shepard Smith here. Thanks for watching CNBC on YouTube.